Unearned revenue, sometimes referred to as deferred revenue, results from the receipt of payment for services not yet performed. When cash is collected in advance, the business incurs a liability for work to be performed, services to be rendered, or goods to be delivered. In accrual basis accounting, a payment received in advance is not recognized as revenue. Only after the revenue is earned can the business recognize it. That is why unearned revenue is also referred to as deferred revenue. Unearned revenue involves both a transaction entry and an adjusting entry. The original transaction entry is made when the cash is received. The adjusting entry is made at the end of the year or other period. Debit cash and set up a liability account that may have a number of titles including unearned revenue, revenue collected in advance, revenue received in advance, and so on. The transaction entry to record the revenue collected in advance is as follows. Debit cash, balance sheet asset account, credit unearned revenue, balance sheet liability account to record revenue received in advance. The adjusting entry at the end of the period simply transfers the amount earned or recognized from the balance sheet account to the income statement account as follows. Debit unearned revenue, balance sheet account. Credit revenue, income statement account. To recognize revenue earned for the period. Examples of revenues received in advance include advances on legal, accounting, programming, consulting, or other services, commissions and royalties received in advance, rent received in advance, interest revenue received in advance, such as in advance of the first month's interest on a loan. Failure to record an adjusting entry will have the following impacts on the financial statements. Liabilities will be overstated on the balance sheet because the omitted adjusting entry would have reduced the liability account. Revenues will be understated on the income statement because the omitted adjusting entry would have increased a revenue account. And as a result, net income will be understated on the income statement. Hilltop Inc. signs a $50,000 painting contract with Buco and receives a $20,000 advance. When Hilltop's year ends, it has completed 10% of the job. What entry is recorded upon receipt of the cash? What adjusting entry is made at year end? The original entry records the receipt of cash. Debit cash, $20,000. Credit unearned revenue, $20,000, to record cash advance on Buco job. Before you can record the adjusting entry at year end, you must compute the amount earned. According to the data, this is a $50,000 job, and Hilltop has completed 10% of it. To compute $50,000 job times 10% completed equals $5,000 earned. Debit unearned revenue, $5,000. Credit revenue, $5,000, to record revenue earned. The debit to unearned revenue reduces liabilities by the amount earned and leaves in this account a balance of $15,000, the amount of revenue that has not been earned. The credit to revenue recognizes $5,000 as income. This can be illustrated with T accounts, where A indicates the original transaction entry and B indicates the adjusting entry. On May 1st, your company collects a cash advance of $24,000 for 1 year's rent. Your company's year ends December 31st. What two possible set of entries original, and adjusting can be used to record collection of the cash advance and recognition of the rent earned as of year-end. On May 1st, original transaction entry, debit cash, $24,000, credit unearned revenue, $24,000 to record rent advance. The credit to unearned revenue creates a liability of $24,000. On December 31st, your company records an adjusting entry that recognizes $16,000 in rent revenue. $24,000 times 8/12 for May through December equals $16,000 earned revenue. December 31st, adjusting entry. Debit unearned revenue, $16,000. Credit revenue, $16,000 to record rent earned. The debit to unearned revenue reduces the liability by the $16,000 earned, leaving a balance of $8,000 to be earned in future months. The credit to rent revenue recognizes the $16,000 earned as of December 31st. Prepare the adjusting journal entry for each situation. You collect a $12,000 advance for 1 year's rent and credit unearned revenue. At year-end, 3 months have elapsed. Debit unearned revenue, $3,000. Credit revenue, $3,000 to record revenue earned. $1,000 per month times 3 months. Your company collects a $20,000 advance for a $100,000 job and credits unearned revenue. At year-end, your company has completed 12% of the job. Debit unearned revenue, $12,000. Credit revenue, $12,000 to record revenue earned. $100,000 times 12%. The amount of revenue recognized depends on the percentage of the $100,000 job completed, not on the $20,000 advance. Prepare the adjusting journal entry for each situation. You collect $24,000 in advance for 1 year's rent and credit unearned revenue. Your company's year ends 3 months later. Debit unearned revenue, $6,000. Credit revenue, $6,000 to record revenue earned. $24,000 advance times 3/12 for the 3 months elapsed. You collect $25,000 in advance for a $100,000 advertising order and credit unearned revenue. You complete 15% of the job before your company's year ends. Debit unearned revenue, $15,000. Credit revenue, $15,000 to record revenue earned. $100,000 job times 15% of job completed. Your firm signs a contract to sell Huntington Inc. products for a 20% commission on sales. During the year, Huntington pays your firm $7,000 in commissions, which you credit to unearned revenue. By year-end, your firm achieves $25,000 in sales. What adjusting entry do you record on December 31st? Debit unearned revenue, $5,000. Credit revenue, $5,000 to record revenue earned. $25,000 times 20%. Only the $5,000 earned can be recognized as revenue at year-end. Unearned revenue appears on a balance sheet as a liability. Revenue is recorded when earned, not when collected. For cash collected in advance, debit, cash, and credit Unearned revenue. 3 possible names for revenue liability accounts are unearned revenue, deferred revenue, revenue received in advance. When revenue is received in advance and part of it is earned by the end of the period, the adjusting entry affects both the income statement and balance sheet. A company collects cash in advance for a job, credits deferred revenue, then completes part of the work. If it fails to record an adjusting entry at year-end, liabilities will be A. Understated, B. Overstated, C. Unaffected. B. Overstated. If a company collects cash in advance for a job and credits deferred revenue, then completes part of the work but fails to record an adjusting entry at year-end, net income is A. Understated, B. Overstated, C. Unaffected. A. Understated.